Picture this, you get your first job out of college. It pays minimum wage, which as of January 2014 is $7.25 an hour. After a 40-hour work week, your boss hands you your very first paycheck, and you are expecting $290 for the week, but the paycheck is only for $232.91. So where did the rest of it go? Well, most probably it went to taxes. There are several kinds of taxes taken out of your paycheck, depending on where you live. Federal, state, and local taxes, and also something called payroll taxes for things like Social Security and Medicare. For our purposes, to understand the basics, let's focus on federal income tax, which is the tax that comes straight out of your paycheck and goes to the United States government. The idea behind federal taxes is to take a small percentage of your earning wages to help financially support the federal government's work. In fact, about 40% of all government revenue comes from individual income tax. There are three different ways that a government can tax its citizens, known as proportional, regressive, and progressive taxes. Proportional taxes take an equal amount from each person regardless of salary. An example is gasoline or sales taxes. Whether you're rich or poor, you pay the same tax rate. Regressive taxes tax the lowest income the highest amount, and the tax decreases as income increases. They impose a greater burden on those with the lowest income, which many people consider unfair. Payroll taxes are an example of a regressive tax because they are capped at a certain limit, making it easier for those with a higher income to pay them off faster. The third type of tax is progressive taxes, where a higher income brings a higher tax rate. To understand the progressive tax method, let's go back to that first paycheck. At 40 hours per week at a minimum wage, your annual income would be around $15,000. Every dollar you make under $9,075 a year is taxed at 10%. So for every dollar over that $9,075, you're taxed 15%. Now the percentage taken out increases in brackets. So if you made $30,000 a year, you would be taxed 15% for anything over $9,075 until you hit $36,900. If you made $70,000, you would be taxed 25% for anything over $36,900. And this continues until your annual income reaches $406,750. Anything above that amount is taxed 39.6%. Now, while these percentages are based on annual income, they are taken out of your pay in small amounts from each paycheck, or pay-as-you-earn taxation. Did all of those numbers give you a headache? They did to me. Well, get this, the tax brackets can change every single year, and lawmakers in Congress almost always battle over what the tax rate should be. And with a budget that is trillions of dollars a year, Congress also fights over where to spend the money coming in. Some categories of spending are required by law to be funded, like Social Security. Other categories, like education, are discretionary spending and can be changed by lawmakers in Congress. Required spending has been steadily increasing over the years, making it difficult for Congress to come up with funding for new programs, something else they battle over. But to help our country function and to keep programs like Social Security and education, the military, infrastructure, and just about everything else the government regulates, including delivering the mail, working it takes taxes.